Hey everybody, welcome to Trading Capital's daily analysis video. It is Monday, June 26th. Jumping into the S&P 500. So today's overall market action was pretty quiet. Analyzing the S&P 500 here on the daily chart, you can notice that the volume was extremely light. This is kind of what we've been expecting leading into the holiday as we lead into the Independence Day, July 4th holiday in the United States. So 54 million shares is extremely light. Typically, lighter volume does favor upside bias in the markets, but overall today you can see that we are finishing down on the day, but it's more or less a pause day or a little consolidation period. So it's actually typically healthy for the markets to not have a massive sharp move down, instead a nice controlled one still inside the upper end of this wide range green bar, which is technically bullish in the short term. And you are consolidating just under the 25-day short-term moving average, still holding this parallel channel that we were trading in. And obviously you can see you are approaching your next point of resistance, which is the top of this parallel channel. So if we do break through there right away, you could go to the gap fill and this, but potentially what we could be looking at over the coming days is maybe another small down day tomorrow, but look for a potential reversal to start maybe on either Wednesday, Thursday, or Friday to the upside. If we don't get that upside reversal within this week, then I definitely think the markets head down to this gap fill and then ultimately potentially down to this 366 gap fill. So that's certainly what I'm watching out for. If we flip to the intraday basis on the S&P 500, notice how today's action, this is your pre-market trading. You gapped up, pre-market over here, a little bit of pre-market trading, and then it opened. You had this initial flush down, and you ultimately filled this gap, which is key. And it looked like these markets were going to crack significantly more, but it tried maintaining the upper range of this this intraday market rally. However, it started to fail later on in the day, and as you can see, there is some sell pressure coming in on the S&P 500 in the last 10-minute candle here. So ultimately, the negative short-term bias is I really wanted you to not take out this pivot. So this was your initial dump pivot in the morning on your high volume. And I wanted the markets to potentially hold this for the remainder of the day and rally up, because what you've made here is now a lower high and a lower low here in the short-term pattern, and you did not take out the highs. So you made a lower high over here. And then essentially what the pattern likes to do in TA is it searches for a higher high or a lower low. And look what you just made on these candles over here. You took out this low by just fractionally, a very, very small amount, but nonetheless on a technical basis, you did make a lower low on the short-term intraday pattern. So to me, this favors a short-term move to the downside tomorrow. We're potentially looking at some next support if it does move down around there. Let me just change that color there. So around this 386, I think will be our next level of support. Ultimately, you can argue that now your next point of resistance is going to be this downsloping trend line. And I foresee that we're going to make a new lower low over here in the short-term pattern, and then we can potentially make some sort of a symmetrical parallel channel. So we'll just have to monitor this and see. Obviously, there's getting a little bit of a late squeeze into the end of the day, and that is just after hours trading on light volume. Generally, you can float markets up on light volume into the end of the day. So summing up today, essentially the financials were down, energy was up, pretty much one of the strongest sectors on the day if you negate the broker dealers. The materials sector was down, industrials were down slightly, consumer staples were down, utilities were up, healthcare was up, and healthcare is interesting, XLV, because it is running into resistance, and it's had a tremendous bounce, a robust bounce off of the lows since it had a sharp decline, and that is kind of matching up with essentially all the pharma company stocks that are heading into extremely overbought conditions again in the short term, and especially some of them like Eli Lilly, BMY, trading with exceptional tech equivalent price to earnings ratios, reaching highs or trading near the all-time highs or making new all-time highs. They're coming into long-term resistance. So there's certain sectors that I think are vulnerable in the shorter term to potentially see more downside. You had real estate also closed down on the day. Consumer discretionary is down 1%. Technology just slightly down, under 1%. Communications was also down, and the Dow Jones Transportation was also slightly down. So it was mixed. You did have more sectors down on the day, hence the reason why we finished lower in the market session. But overall, if we take a look at the QQQ, NASDAQ over here, very similar pattern to the S&P. You had this gap up, pre-market trading, massive sell-off when the markets opened. Then you had a little bit of a short-term rally, failed to make a new high, sold off, and you're actually making now a series of lower lows. And this is kind of what the pattern I was looking for, but on the NASDAQ, it's actually a down-sloping wedge pattern. And down-sloping wedge patterns actually favor a move to the upside. So this favors an upside break at some point, whereas most people think an upsloping wedge favors a move to the upside, but it actually favors a move down to the downside. So this pattern is actually short-term bullish. Ultimately, what we want to see on the NASDAQ now is if it can start consolidating above this short-term hourly moving average, that would be extremely bullish. You really want to see it hold these levels now. You would hope to think that this potential bottoming tail is going to be the last lower low in the short-term pattern before it breaks up. And ultimately, I do think if you look on the daily chart, you're very close to filling this gap. I think now that you're consolidating, and on a daily basis, which is obviously the more powerful long-term pattern, I think it is bullish in the short term that you have now closed and consolidated above this 25-day moving average on the daily chart. So essentially what that means is if we get some sort of a confirmation or even another consolidation period tomorrow that doesn't really negate these lows, that could be a very, very healthy bullish consolidation that we can potentially play in the short term to capture a quick, sharp move to the upside. So we'll just have to continue to monitor. It is still very premature. It's an early pattern, but it's good to denote what we're looking for ahead of time. If we take a look at USO, so the USO was an extremely, it did have a robust bounce today, up just over 2%. If we flip to the daily chart, the first short level I'm looking for is this gap fill, maybe a little bit more since we came very close to filling it today, but just shy of that gap fill. So ultimately, I am looking to short oil. I do think you have more downside. I think you've created a lot of technical damage, and especially if we look at the WTI, you're able to recapture this long-term trend line that we've been watching. It is now it is resistance still. You haven't confirmed above it, but if you confirm above it tomorrow, it looks like we're heading to that 50% retrace of this down move, which is definitely a good risk to reward area to start accumulating a short position. Because as much as there's still so many energy bulls out there, I still think oil has some significant downside just due to the macro side of a slowing global economy. One can argue about Russia tensions, which I think has been priced in. But due to the fact nothing beats really the larger macro pattern, which is demand destruction, an aggressive tightening Fed. Well, not really an aggressive Fed, but more aggressive than what we've really experienced in the last few decades. So we'll just have to continue to monitor oil. I hope it does push up in the event that we get another short opportunity. Taking a look at natural gas, so beautiful job at covering our short on natural gas in and around these wick lows over here. Because look what we got today. Natural gas was close up to about 5 or 6% on the day. It closed up 3.8% on the day. So it's still inside this wide range red bar sell-off. So ultimately you can argue it's still potentially putting in more bearish consolidation. It's still premature. It is into support. You can see where it got bought up right at these pivots over here. We were looking for a slight flush lower. Ultimately, you can't always get what you want in terms of trading, but nonetheless, we'll continue to monitor this because now what I foresee is I'm looking for this type of bounce right into this resistance, this downsloping, this upsloping parallel channel, or potentially this red line just around the 7 or a pierce of $7. That's what I'm looking for. That would be a substantial bounce in natural gas, and I'll be willing to start accumulating yet again another short position via either just shorting UNG or buying the KOLD, which is the 2 times leverage short play on natural gas. So let's continue to monitor this. I do think natural gas has more downside, so if we continue to get that bounce up, which we'll have to continue to see. This is going to be your first challenge to get through this wide range red bar. Ultimately, once you get through that, it's a very short distance to close in the gap at your first major resistance point. So let's continue to monitor that, and if it does get into that level, we will pull the short on natural gas. Let's touch base on what happened with gold today. So gold, there were some headlines around gold that the G7 countries are looking to ban Russian gold exports, and honestly, that is just ridiculous, those types of headlines. Gold is essentially one of the most untraceable elements, if you want it to be, in the sense that you can just melt it down and you don't know where that gold's come from. It's not like you can test the gold and find out, oh, this gold has some old soil on it. It must be from Russia. We can pinpoint it that it was mined in Russia. No, once you melt it down, that's it. There's no trace of where it's come from. So countries are not going to be able to stop Russian gold. If Russia sells to China, if Russia sells to India, if Russia sells to Saudi, if Russia sells to basically any of the other hundreds of countries that aren't partaking in the G20 sanctions, then, or the G7 sanctions, I apologize, then the G7 countries will have no idea that they could be potentially owning and buying Russian gold. So I just think that is just a waste of time. They really come up with stupid ideas, our politicians, without really thinking things through. It's just one way to kind of manipulate and suppress potentially the precious metals in the short term. Notice how we're still trading in this wedge pattern for gold. You're holding your higher lows over here. You don't really want to see it crack these lows. If you crack this low, you're going to test this low over here. And ultimately, if you test this low, it looks like you probably will go a little bit lower, potentially to see a triple bottom around the low 1700s, 1725-ish. So we'll just have to monitor it for now. It is still technically, I think we are making somewhat of a move that could represent a previous cycle that we experienced all the way down over here, where you had your double top, you had your multiple week of sell-off, and then you just had this grind. And if you look, the grind was more or less along the 50-day moving average. And if we flip back to where we are, gold is right now grinding along the 50-week moving average, just slightly below. You haven't confirmed below it yet on a weekly basis. So we could be in a very similar time to the previous cycle that we just showed. The key thing is that what we're going to watch is what I don't want to see. Well, honestly, it doesn't really matter if I do see it. If we don't see it, we'll adjust accordingly. But essentially, if the US 10-year starts to decline sharply as gold sells off, then that's where we should be getting concerned. Because if we flip to the weekly chart on this US 10-year, so this is currently where we are. You can argue this isn't a topping tail. It was close to being one, but it's not a topping tail. But it is showing you that there's resistance up there for rates. And the reason there's resistance, if you simply take this pivot in 1987, connect another pivot in 94, connect another pivot in 99, it connects your pivot in 2007 before your housing crisis, and look what you just hit. You just pierced through that, but you've checked back underneath it, and now you looks to be consolidating under that major trend line of resistance, that multi-decade resistance line, before it potentially pushes up. So I think you could come down to now this 2.74%, which is another channel going all the way back to the 80s over here, where it connects a pivot high in 81, another pivot high in 84, another pivot high here in the 07 crisis, and then a pivot high here in 2018, and then look at your pivot low where it checked back for support. So essentially that's your big level of support on rates, is the 2.73, 2.74 mark. It is a downsloping channel, so the longer this goes on, the lower this support line goes. But now it is a very shallow decline, so it won't be dropping that fast on you, and this is a weekly time frame, so this is a longer term perspective that we're getting. Overall, what I was saying with gold, if gold starts to sell off and if rates start to decline and break key support areas like potentially this parallel channel, that's a red flag for a potential crash. That's generally what happens here. You saw this interest rate decline from a high. You put in this little weekly double top, with 1, 2, 3, 4 weeks in between, and then you broke key support over here, and that was your massive signal to get out of the markets, because what happened? COVID hit around March 4th. So essentially when the lowest part of the sell-off, that's when COVID was in the world. But you could have avoided that whole sharp decline in rates because the bond market was forecasting it. Let's go to another example. Over here, we had a little bit of a taper tantrum. We had this massive increase in rates from 2012, 2013, all the way to 2014, and then we saw this break, a key pivotal break in support, and look what it transpired. There was this big market tantrum that led into 2016 as well, and eventually, you know, things stabled out with economic policy pivoting. Here again, we had another example, 2003. Rates in this continuous uptrend. Essentially, these green boxes are 4 years of upsides in rates. Each box represents 1 year of price action. And then look what happened. On your 5th year, or 4.5 years in, you made this beautiful double top. Here's your double top over here. A long period of price action between. Failed to take out that high, and rates started collapsing, pricing in some sort of catastrophic event in early or in late 2007. And what transpired then was the housing collapse. But you had signals of double tops in rates and failed breakouts, and collapsing through key supports is enough on a technical basis to say, hey, maybe I should reposition my portfolio in the event of some sort of black swan event, because it certainly looks like something bad and negative is about to transpire. Yet again, another example. If we go to the dot-com bubble, simply take a trend line from the 98 rise all the way up to your highest pivot that you can find, which happened to be in 1999 over here, and then you reached your peak in 2000 over here. It also happened to come into a major resistance points from several years back. It kind of is a failed breakout move because you did not pierce this downsloping channel. You could not break out of that. And look, you broke key support, and what transpired in the year 2000s? The dot-com crash. And look at how rates ended up collapsing. So these are the signals in the bond market that we will continue to watch for and certainly bring to your attention when we see it. We're nowhere close to it yet. Certainly, you know, if we see something in the lines of breaking, let's remove this for a second, or at least minimize it. So if we see this type of trend line break, this yellow trend line at the bottom, let me just thicken it up. That is going to be a super red flag for me. So I still have it priced in that for the rest of the year, and potentially into the start of the year, interest rates start rolling over, which is going to forecast that inevitable drop. Now, fear can always take over and change patterns sharply in the short term. So in the event we get some sort of banking crisis, a bank goes insolvent, you know, extra liquidations and margin calls from the crypto space. Overall, if we get recession fears and talks, and we have that global recession announced earlier than expected, or even a recession in the United States of America earlier than expected, potentially July Q2, or when we get the Q2 numbers in mid-July. You know, a lot of things in the short term can adjust and create fear, which can ultimately change the price action and have a sharper decline proceed. But this just shows you that sometime between now and potentially the end of the year, which is where this trend line of support goes, you could look for a crash. Now, if the price action of rates continue to rise, then ultimately this trend line goes higher too, which will give you additional time on the clock before we potentially get that bond market signal of a catastrophic black swan event. So lots to consider. We'll continue to update you on how things progress. Overall, it was a healthy pullback in the markets. Our portfolio did finish up a little bit today, but it was certainly a little flat on the day. So just a little small move in the right direction. Ultimately, we did take profits on Apple, so congratulations. You know, we didn't really hold that trade for very long. It was about a week, 7 trading days, for a beautiful profit of 9.82%. So those are the types of swing trades where we're in, we're out, the risk to reward has been eaten up, and we've banked our profits, so that's fine by me, because the next down leg, when we're in a bear market and down legs start, there's certainly certainly a lot of power and fear that drives it down. You know, stocks take the staircase up, but the elevator down, and that's what we've seen. We also added to our BMY. Oh yeah, before we end the video here, XLV, I wanted to discuss healthcare. So XLV is interesting. If we flip to the daily chart, you can see that XLV has had this robust move off the lows. Let me just take this volume out. So you had this robust move off the low. You had a 1, pause, a 2, 3, 4, 5, 6 days out of 7 days of upside, and this is actually, I believe it was just a flat day or slightly positive. No, it would have been a slightly negative day. Sorry, my apologies. But 6 out of the 7 days positive. You're now into major resistance on the daily chart. Key moving averages approaching fast. If we do flip to the weekly chart, you can see you are into this 3-bar wide range sell-off, and this is critical because if we now turn back our volume, this wide range sell-off happened on an increasing volume trend. And whereas so far, yes, the week just started, so there's 4 more days, we'll have to really see. If you notice the volume decreasing, it's unlikely that you're going to get through this major resistance zone. Because this is an increasing volume trend on a 3-bar surge, weekly surge to a low, you're going to have to see an increasing volume trend. So this volume bar at the end of the week needs to be higher than its previous green candle, which should be a pretty difficult thing to do considering it's had a sharp move up, and unless there's massive distribution happening, we'll have to wait and see. But overall, I am favoring that the healthcare sector does see some sort of a pullback. You do obviously have the potential of coming up to fill this gap at 133. I'll look to personally short this sector at that level. We are holding individual stocks within the sector that I think are just outlandishly overpriced. But hey, the market makes prices that the market sees fit, and ultimately it changes on a dime. We know that. And then you do have a secondary gap fill up here around the 138 level. That would be a beautiful, beautiful shorting area. Eli Lilly is an interesting one because ultimately, if we take a look at Eli Lilly is just hit some. Let's go to a longer term view. Let's start off with the longer term view, shall we? So if we go to the monthly chart on Eli Lilly, first thing I want to bring to your attention is you've had 1, 2, 3, 4, 5 months of upside. A very, very powerful move to the upside. And the interesting thing is you just hit this beautiful parallel channel of resistance. Let's flip back to the weekly chart now. So if you notice, this was your high in August of 21. You came, you almost tested the lows, bounced up, almost tested the highs, tested the lows at support again, had this impeccable surge up to the highs again, checked back, made a new high, checked back, and this is very similar price action to what we were analyzing on natural gas. You're making now a series of higher highs. However, the highs are running out of steam. You're not having very much robust moves to the upside that are making significantly newer highs. So that is concerning because whenever you see a sharp move to a new high, it's usually followed by a lot of positivity and optimism, and people chase this, a lot of momentum chasers out there. So typically you do see a lot of money flowing into these stocks that are making new highs because people are chasing the momentum. And when these stocks aren't making considerably higher new highs than the previous one, it shows that money is distributing into the buyers. So longer term money, big money, is likely distributing and selling shares as new buyers come in. And if you notice on the daily chart, you're on a 1, 2, 3, 4, 5, 6 candle surge into resistance at a new all-time high. That is a beautiful opportunity, enough for me to pull a short. You have 3 technical figures there. If you simply look at the PEs of most of these pharma companies like Eli Lilly, BMY, Bristol Myers, they're trading like tech stocks. Above 45 on these multi-billion-dollar companies is just absolutely insane. And eventually the bear market does get all leading sectors. The beautiful thing is that we're slowly accumulating shorts. We're positioning ourselves on the defensive side of the market because the downside will come. It will come sharp, it will come fast, and I think it's going to catch a lot of people off guard again, because that's generally how the markets move, is they catch people off guard when they're not expecting it. Could this rally up and make a new high? Yeah, it certainly could. That's why we have a secondary resistance point already mapped out. If you look at the longer term picture, this beautiful pivot high going back in 2019 over here, all the way to 2021, and it would take you up to about the 363 mark, give or take. So we're certainly got multiple levels that we will use to establish good opportunities, but ultimately this stock is extremely overbought in all metrics. It is a powerhouse, so it can continue to move up, but ultimately we are getting a lot of technical signals that it's time to start accumulating, and accumulate we will. So that's it for today. Hope all this analysis helps. We'll continue to monitor the charts, and we'll see you tomorrow. Take care, everybody. Thanks again for being members.